Hello, this is Paul Jewell with Hancock Mortgage Partners, and this is Mortgage 101 FHA loans. So today I'm going to talk a little bit about FHA loans. And FHA loans, FHA is an acronym for Federal Housing Administration Loan. This does not mean that the federal government is lending the money. It just means that the federal government is insuring the loan. And what that means even more in depth is if you close on an FHA loan and you fail to make your payments and your house was taken away from you, the FHA mortgage insurance would help offset any losses related to that event. So I'm going to cover briefly the benefits of an FHA loan. First, we'll start with Northeast Florida, which is where I am. Maximum loan amount for single-family dwelling in Northeast Florida is $314,827. So it's pretty, can buy a pretty large home, and that's been increased since last year. The types of homes can be single-family dwellings. It could be condominiums. It can be multi-family dwellings. One or two units where you're going to live in one side, maybe rent out the other side. Can't be used on investment properties, but our second home. So it has to be your primary residence. That's a biggie. The benefits of it are it does not require a high FICO score. So credit scores can be lower than on a conventional loan. For example, in FHA, I can go as low as 580 on a credit score. And if you have a large enough down payment, I can even go lower than that. Now, one thing you should keep in mind is the lower the credit score, the higher the interest rate. So just keep that in mind, and higher the fees. The other thing, the other benefit of an FHA loan is what we call a debt to income ratio. And so the easy way to kind of think about a debt to income ratio is it's your income. Actually, it's your total debts plus the house payment divided by your income is a debt to income ratio. And FHA will allow, I've closed loans up to 55, 56% with good credit scores. So what that means is you're able to borrow more money, buy more house, because it has more lenient debt to income ratio restrictions. Speaking to another benefit is the down payment. The down payment on an FHA loan is 3.5%. It's always been that way in the 20 plus years I've been doing FHA loans. So 3.5% of the sales price is the down payment. On a side note, that down payment can come from a 100% gift from a family member. I've even had people that own their cars free and clear, and they were able to go and take a secured loan out on the car. And as long as they can carry the extra payment on the car and the new payment, boom, that's a source for down payment on an FHA loan. Lots of other places to work that out as well. So message me if you have other questions about that. One cool thing about an FHA loan, I was working with a client, this is last year, middle of last year, and on her own, she couldn't really qualify for a whole lot. I think around 150, 160, 5,000. And we just couldn't find a house that fit her needs because she had 4 children, was married, and they needed a much bigger house. So FHA allows for what's called a non-occupant co-borrower. Luckily, her aunt, who lives up in New York, was able to help her as a non-occupant co-borrower. So I was able to take the aunt's income and apply to her income and get her family into the home that they wanted to get into and easily qualify for it with a non-occupant co-borrower. FHA loans also feature a lower interest rate. So if conventional today, and I'm just using examples, is 5.25%, FHA is going to be 0.25% lower than that pretty much most of the time. The only difference is, again, if the credit scores are lower, you will pay a penalty on that rate. If there's a negative to an FHA loan, probably I would say the only negative that I run into on FHA loans are the mortgage insurance. So mortgage insurance is MIP is an acronym for mortgage insurance. You may hear of it as MIP. And on an FHA loan, if you put the bare minimum down, 3.5% down, you're going to carry that mortgage insurance for the life of your loan. Now, if you put 10% down on an FHA loan, that mortgage insurance is going to drop off in approximately 13 years or less. But when the original loan amount reaches 78% of the amount borrowed, so example, $100,000 loan, you pay that down to $78,000, that mortgage insurance is going to come off as long as you put 10% down or more on an FHA loan. Now, if you came to me and said, hey, Paul, we're going to put 10% down, we would have to really look at, does an FHA loan make sense? Oftentimes it wouldn't, because on a conventional loan, if you've got great credit, the mortgage insurance is going to be less, and the interest rate is going to be slightly higher, 0.25%, but it's not going to offset the difference that you might see for that mortgage insurance difference. Anyway, I'm touching on FHA. I'm going to cover other subjects as well. If you have ideas you'd like me to cover, for example, I'm going to go into VA loans and USDA loans and conventional loans and down payment assistance programs. I'm going to cover all that stuff. But what I do invite you to do is, if you'd like to learn more about mortgages, I would encourage you to comment on this video, and you can ask me questions, and I'll be happy to answer your questions. But I would also tell you, make sure you're working with a loan professional who has a lot of experience, knows how to structure a loan, and can help explain the process not only to you, but to all parties involved, because it's extremely important to hold that deal together, that everybody understand what's going on. So, hey, I want to thank you for taking time to watch this video. And again, I encourage you to make your comments below if you'd like to see more, and I hope you have a fantastic day. This has been Paul Jewell with Hancock Mortgage Partners, Mortgage 101 FHA Loans. Have a great day.